Okay, welcome everybody. Finance 444, week 3, over halfway done. If you've got your coursework done to this point, you're over halfway there. Only got one more week of discussion boards and assignments, and we've just got the test this week and a final next week, and you're finished with the course. Seems like we just got started and we're already finished. Thank you, Salinas, Tina, and Michelle for being part of the call tonight or part of the session. Hope that you'll have an opportunity to chime in as you have questions or concerns or anything that you have any feedback on. So we'll get started here in just a second. What we want to do tonight is we want to give a little bit of feedback from last week, the coursework from last week. We want to give you a little bit of a heads up for this week as far as what will be expected. And then we will cover some slides from Chapter 11. Chapter 11 is the only chapter that you have to cover for this week, so it's nice. You go from 2 chapters down to 1. Next week is a 1-chapter week as well. The test this week is not comprehensive, so that's nice as well. And after we're done covering the slides from tonight, we'll spend that last 10-15 minutes going over the 25 questions that will be on the test. They are true, false, and multiple choice questions straight out from the text. I will say that I've been very pleasantly surprised and impressed with how well all of you are doing with the tests. I think it just has to do with having a textbook as opposed to the Investopedia site like we talked about last week. But anyway, those of you who completed the test last week as far as the midterm did a very good job, so congratulations. Most of you are doing very well on the course. Unless you're just missing some assignments or missing some of the coursework, most of you are doing very well. Yeah, it all has to do with matching, right, Michelle? As long as we don't have matching, you're in good shape. I think those matching questions were just the end of you last course, but you still ended up with an A in the class, so just goes to show that you can have challenges like that and still do great. As long as everything else, you do a good job on it, right? So for tonight, like I say, let's look back a little bit at last week and then look forward a little bit at this week as far as the coursework. Last week, the discussion board was strong. The assignments, like I say, that were turned in were strong. I did have a few of you, a couple minor issues. One is I had a few of you just attach the wrong submission, just obviously the wrong assignment for the wrong class, and that happens once in a while. I completely understand, but just make sure that you don't avoid resubmitting, right? So I assume that you have the right assignment. You just need to go in and check, and if you see a score on that assignment that doesn't look right, that you're just not getting the grade that you had hoped for, or not even getting a majority of the credit, then please check the notes and resubmit the right assignment if that happens, okay? Yeah, I think, Michelle, it happens to all of us, right? You got fortunate for you that you did it before it was due, but I think all of us have had a situation where we're just rushing through and we just attach the wrong attachment. No big deal, but just make sure and don't let that stand, because your score is poor, if you turn in the wrong thing. And then the other minor thing that happened last week, and it's not minor for the person that did it, but it is minor in a class like this. Every once in a while we'll have 1 or 2 people that have this happen. But if you submit something, the college has technology that basically just tells me as the instructor whether or not, and I think it even tells you as the participant whether or not the assignment is, how much of it is borrowed material versus how much of it is your own unique writing. And if you turn something in and it's above 80 or 90%, then that's a huge red flag, and I have to have you do it over again. And if you do that multiple times, then you get a 0 in the class, you fail the class, and you potentially can get expelled from the school. So it's serious. It's a serious issue. Having said that, we only had one person. It might have been a mistake. As far as what they submitted, I don't know, but I always try to give people the benefit of the doubt on it. But if you see when you turn something in that you're at 80 or 90%, you may want to check what you submitted and make sure that it was the right thing. The other thing you just have to be very, very careful about with these online classes is that you don't ever borrow word-for-word material, from an online source. You always have to try to the best of your ability to reword things. You still cite, your references, but you need to reword things the best you can. The majority of a paper should be your own unique writing. So if you're seeing anything over about 20 or 30%, Michelle, you and I have had this conversation in the past, because some assignments where they're short answer questions, if you copy and paste from the book what the book questions are, sometimes your statistic will go up, right? So anyway, that's the it's a challenge. And so I just encourage, the one, maybe two of you. I think it was only one of you that this last week that I just couldn't give any credit to because 99% of it was showing as a match to other people's work online. To just resubmit, do your own unique work and make sure that doesn't happen again so I can give you full credit. Okay? All right, enough of that. For those of you who are on the call tonight, I don't think it's ever probably been an issue, but just a good reminder that we try to avoid whenever possible, using other people's work word for word. We'd much rather, if we're going to do just a small quote, that's fine. We reference it and quote it, but the majority of our writing should be our own unique writing, and us putting things into our own words. Okay. All right. So that's the assignment from last week. Like I say, most of you did a great job on the assessment as far as the midterm and also the discussion board last week. We just got a few of you who are finding yourselves behind at this point. And as I will every single week from here on out, this week and next week, I'll just encourage you to not give up, to continue, trying to set time aside and schedule time so that you can get, things taken care of, okay, and get caught up. You're not too far behind at this point to still get caught up and still pass the class, but we've got to start planning ahead so we don't get caught at the end without enough time to finish. All right. Any questions about last week before we take a quick look at this week? Okay, so a couple things that we need to think about for this week. First of all, and the biggest thing is, I've already kind of alluded to the test this week. It's just a regular test, 25 questions, 50 points, just more like the week 1 test, so not nearly as long, just straight from chapter 11. Should be pretty straightforward. We'll go over the material here in a few minutes as far as just giving you an outline of what to expect. What we do need to talk about is so we've got a discussion board question that just has to do with tracking investments, and I hope that you'll do some research on different tracking tools, different ways that tracking can help. I mean, there's all kinds of different ways that you can take the discussion board question so that we don't end up with the same answers over and over again on this week's board. And so keep that in mind. But the discussion board's pretty straightforward. The thing that's not straightforward is the fact that I just went in today and I changed the instructions for this week's assignment. So Michelle, I'm sorry, but for those of you who have looked ahead and already, printed off the instructions for this week's assignment, and I'll put this on the announcements as well, just to give everybody a heads up, but I did add 2 more problems to this week's assignment, and I got rid of the writing requirement. Most of the assignments in this class, you'll notice, are kind of in a short answer format. And so for this week, instead of trying to get you to write 2 pages about something that really was going to be about a half a page of short answers, instead, I just thought, well, let's just make it a little bit more robust by adding these 2 other questions. So it's on the same page, okay, but it's 1, 2, and 3 instead of just number 2, okay? So it'll take a little bit longer, but you don't have to worry about some kind of writing minimum or trying to make the paper more, you don't have to look up any sources or anything like that. You just need to go through, number the different questions, and answer them so that I can find your answers very easily when I go to grade it. So any questions about that for this week? Just take care that you've looked at the instruction. Most of you haven't even looked at the assignment for this week, but if you have, and if you've already printed that off or taken a shot of it or something like that or committed it to memory, just know that I have updated those instructions as of today, and the assignment is 1, 2, and 3 on that same page as opposed to just number 2. Okay? All right. So if you have any questions on that, let me know, but they're short answer questions. Make sure and format your paper as a short answer question paper, meaning use numbers, use letters if the book does as far as the questions are concerned, and then use full sentences in your full sentences in your answers. Okay, it doesn't have to be paragraphs, but just use a complete full sentence instead of just 2-word answers that aren't even a complete sentence. Okay. All right. That's this week's assignment. That's what I needed to give you as far as a heads up on this week's instructions change. So with that, we can move on. We've got some slides from chapter 11 we want to cover. And Michelle, why darn it? You wanted to say something different than that, but you're editing yourself. You're speaking nicely on the board here. Did you already do number 2? Yeah. So you're almost done with it. That just means that you need to add 1 and 3, and you can still use the number 2 work that you've already done. So you're in good shape. You'll be fine. Okay, so we want to cover, no, it doesn't have to be in order. Just make sure I know what you're answering, right? So don't put it in a format where I can't easily look at the paper and find where your answers are to what questions. So just make sure you've got subject lines or titles or something so that I can know exactly where you are in the work. If you start with number 2, then just put number 2 on the top of it so I know where you're at, okay? All right, so this week is Chapter 11, Investment Planning, okay? And there's some overarching kind of general themes about this chapter that are very similar to some of the material that we've covered in 443. So if you remember anything from 443, which I know some of you, even though it was just a few short weeks ago, have probably tried to put as much of that out of your memory as possible and just move on, right? Just get done with it. So some of tonight will be a review for those of you who really got into that material. But I think that the book, this particular textbook, just does a better job of formatting the information so it's easier to remember and retain as you study it. So when we talk about investment planning, we've got some different things that we need to consider right off the bat. I don't know if I mentioned this to 440, those of you who are in 443, but I always, whenever we talk about investing, I'll usually bring it up, and that is that I often or commonly have people say, I don't want to invest in the stock market. It's just like gambling with my money. Okay? I don't want to invest in the stock market. It's just like gambling with my money. I'd rather go to Vegas and have fun than put my money in the market where it'll just go away or disappear or go to zero. Okay? So that's a line that I hear from clients, and I also hear it from people in the courses that I teach when we teach about investing. And I would make a differentiation and I do with my customers and clients by saying the following. Investing is an activity that you do, okay, that the odds are easily in your favor, okay, overwhelmingly in your favor, meaning 99% of the time, if you just hold that investment long enough or that strategy long enough or that portfolio long enough, you're going to go up. You're going to benefit. You're going to gain, okay? Will it fluctuate? Yes. But will it go up over time? Yes. Okay, so you can see how that correlates to that left-hand box. Is everybody able to see the box on the left that defines investing? Usually long-term, that's what it starts with. Okay, hi Jack, welcome. So investing is putting the odds in your favor, right? To borrow from, or actually, the term from, oh geez, what's the Hunger Games, right? Put the odds in your favor. May the odds be in your favor. But anyway, when you invest, you're putting long-term the odds in your favor, okay? When you speculate, this is where it gets closer to gambling, okay? Because when you speculate, usually it's a short-term thing that you're trying to do, and it has a very high uncertainty level, okay? So let's say I go out and buy a penny stock, hoping that that company will turn itself around, because 99% of the time, penny stocks go to zero. And the reason they're priced in the pennies is because people already assume they're going to go to zero, and the only people buying that stock are people who are speculating or gambling, trying to make a lot of money off that one position on the off chance that that company might be able to turn itself around. Okay? But the odds are definitely against them when it comes to penny stocks, when it comes to speculating in the short term. Okay? So I would say that type of investing, and it's not even an investing, it's just that type of speculating is more similar to gambling. When you're long-term investing, when you're building portfolios that are diversified, that are balanced, then the odds are in your favor as long as, okay, and this is the big caveat with investing, as long as you're long-term. Okay, short-term, all bets are off. The market will go up and down. We know that, right? You could lose some, you could gain some in the very short term. But long term, and especially when people are looking at retirement planning 10 years out or longer, we put the odds in our favor by having a balanced portfolio or diversified portfolio with a good asset allocation and just holding tight, because 99% of the time that will go up. Okay, so odds are in our favor. All right, any questions about the difference between investing or speculating, or how I like to, the differentiation that I make, which is the difference between investing in the market versus speculating in the market? Okay, pretty straightforward, pretty clear? Investing versus speculating. So just make sure you have the general idea here. So how do people get started with their investments? So the easiest way that people get started with investing is just to have a 401k or IRA through work, right? Something that they don't have to set up themselves. They can just enroll in it with all their other benefits. Like if I work at Walmart, then I'll have a 401k plan through Merrill Lynch. Or if I'm in Utah County and I work for the hospital, for example, UVRMC, which is the biggest hospital here, through Select Health, then I have a 401k plan through T. Rowe Price. Or if I work for Nu Skin, which is another big company in Provo, I have a 401k through the Principal. Okay, so there's all these different 401k plans, and if I work for those companies and I work full time, then I'm going to have access to a 401k plan, and that's one of the most simple and one of the most common ways that people start investing is through their workplace. But a lot of people don't have access to a plan through their work. They still want to invest, or they still want to learn about investing, and so what do? And one of the options that they have is to go to a site like Investopedia, which we used in 443, and basically just set up the simulator through. So if you search for simulators when you're on the Investopedia site, it will take you to a place where you register. Okay, you register just some very basic information, and then you can buy and sell stocks or buy and sell any kind of investment you want, and it simulates how that investment would do, but you're not having to use your own money. Okay, so that's what we talk about when we're talking about using different technology to play trade. What we're talking about is using something like that Investopedia site so that you can practice, right, on somebody else or on a game before you actually put your hard-earned money to work. But then after that, if you get some comfort level and just want to take the dive and want to invest in something like Disney or Costco or Walmart or Target, and you say, you know what, this is what I want to do, then set aside a little bit of money each month and start an account with a place like ShareBuilder, okay, through ING or Voya. There's a lot of different companies, American Express and others, that have now trading sites associated with them as well. And you want to find one that will allow you to systematically or automatically invest each month just a little bit into a stock, so that over time you can accumulate a position, but you don't have to think about it every month. It just automatically contributes to your plan, to your investment plan through your bank account without you having to do anything. The more automated you make it, the more successful you'll be. The more thought process has to go into it, and the more manual it is, the harder it's going to be. That's consistent with almost anything in life, right? The easier it is, okay, as far as creating a pattern or a habit, the more successful we'll be. The harder it is to create a pattern or habit, the harder it is for us to accomplish what it is we want to accomplish. And investing is no different. If we can make it automatic and make it simple, then it will happen. If we have to think about it and worry about it every month, then it probably won't happen. Okay? All right, so those are some ideas as far as getting started with investing. Yeah, Tina, every single site has its own minimum amount. So that's something to be aware of, like at Fidelity versus E-Trade versus Ameritrade. They all have different minimums. But the one I just referred to just a minute ago, ShareBuilder or Scottrade, they tend to have lower minimums. And so there are sites now, as far as trading sites, that don't have any minimums. But most sites will have you do like $500, for example, as a minimum amount. And a lot of us don't even have 500, right? So the better starting thing to do is just start a savings account through a bank, automatically throw in whatever we can, maybe $25 a pay period or $50 a pay period. Kind of treat it like a utility, like a cell phone bill, right, that we're just going to do every month automatically. And then once there's $500 in there, then we can transfer it into one of these trading platforms if they do have a minimum that's 500, like I mentioned. Okay. So we talked about in 443, and you've probably already forgotten this, but there are different objectives that people have when they go to invest. It could be to create current income right now, could be to live comfortably in retirement, could be to stop taxes, or reduce their taxes, could be to grow their money as fast as they possibly can, could be to save for college education or something else that's in the future, some kind of major expense like a car or second home or something like that. So there's all kinds of different objectives and goals, and those goals will usually be the key factor in what we invest in, right? What types of options we look at from an investing perspective, because depending on what we're going to focus on, that's going to change the types of investments that we use. So it's not like as an advisor they just have some pet investments, and I say pet investments, but they don't have just some favorite investments that they give to every single person that they talk to. Some advisors might, but most advisors have different products and solutions available to them based on or depending on what the client objectives are. So if the client says, I want to retire comfortably, and that's 30 years from now, there's probably some kind of aggressive portfolio in mutual funds or stocks that would achieve that. If they want high current income, there's probably a portfolio of bonds or fixed income mutual funds that can create current income. But that's different than, the person who wants to retire in 30 years and wants to grow it as fast as they can. And that's also different from somebody who's just trying to reduce their taxes as much as possible. If somebody's trying to reduce their taxes, we look at 401k planning, IRA planning, and municipal bonds that pay tax-free income. So each one of these objectives kind of has its own set of products as far as the type of account, and then also what type of investment you put inside that product. So I might have a brokerage account that's an investment account. That's the account type. But I could have a goal of any one of these objectives and put just a different investment inside of that investment account. But with things like educational IRAs and 529s, those are only for children's education. So you've got different account types, and then you've got different investments inside of them as well. A lot of people walk into the bank and they say, hey, my CPA told me to open an IRA. How much do you guys pay on IRAs? Meaning, how much do you give an interest on IRAs? And my response is, it just depends on what you put in it, right? The IRA is just the umbrella that's a tax-efficient vehicle for retirement. But what you put inside it's going to dictate what kind of return that you get, or what kind of interest you get, or how much it grows. So if I put bonds in, my expectation is going to be 3 to 5%. If I put stocks in, it might be 6 to 10%. If I put emerging markets or international funds, it might be even higher. So it just depends on how I invest inside of those accounts, those different account types, and that will dictate how much of a return I get and how much risk I'm taking, right? Because we always have to keep in mind that risk-return trade-off that we talked about in the last course. So we always want to know how much we're going to need, right? And one of the things we talked about last week for the assignment is, how much do you need in an emergency fund? And the book, of course, talked about having at least 6 months worth of income. But one of you mentioned that if you look at like Susie Orman or Dave Ramsey, they all have kind of different thresholds, minimum thresholds of amounts that you need in savings before it makes sense to really invest in the future. And what I would say to that is that this is true, but those of you who are thinking, hey, I'm never going to get that much money sitting in the bank, then you can already see the problem with this, because if you don't get that money in the bank with one of their programs, then they would say don't ever invest for the future. And I would say if you have access to a 401k and free money, you do that no matter whether or not you have an emergency fund or not. And then on top of that free money that you can get through a 401k through your employer, you also try to, on a monthly basis, electronically add to that emergency reserve account that we talked about for the assignment last week. So we try to make progress, on multiple fronts. It's the other thing that I commonly will talk to people about is that they will come in and say, okay, I want to invest, but I also want to pay off my house. So should I just put all my extra money towards my house? And I'll usually say something effective, let's come up with a plan where you can put extra money towards your house and do some investing. Because some people get to a point where they've got everything paid off by 55 or 60, and we say, congratulations, you've got everything paid off. But they focus so hard on paying everything off that they have no savings, they have no investments, and they have no retirement plan. And then at age 50 or 55, when they're debt-free, they can save quite a bit, but we don't have enough time to get compounding interest and really make their money work for them the way we'd want to. So the power of compounding interest is a situation that really bodes well for those of you who will start early. Okay, the earlier you start, the better. We've got to start early so we can have those investments compound on themselves and really grow exponentially. If we wait until we have everything paid off, sometimes we don't have enough time to allow our money to grow the way we should have. Okay? Doesn't mean that paying off debt's not a very important goal. It's one of the most important things. I would even say it is the most important thing as far as getting to a retirement that's comfortable is having all our debts paid off. Now, there are all kinds of different ways that we can invest. We can invest in common stock, bonds, preferreds or convertibles, which are types of stock or bonds, mutual funds, exchange traded funds, which are ETFs we talked about last class, exchange traded notes or ETNs, which is a little bit of a variation on ETFs, and then also real estate. But you could add precious metals, you can add all kinds of other things to this list. This is just kind of a starting list of different things that you could potentially look at and research to invest in. Okay, so what are these different investments? What does it actually mean? What do they all mean? So if you'll recall from last class, I think that a common stock is equity ownership or partial ownership in a company, right? We talked about how if you invest in Microsoft or Apple or Google and you have stock of those companies, then you have partial interest or partial equity. You actually have some ownership interest in that company, albeit very, very small and very little power, right? But you have access to a part of the value or future value expectation of that company, as well as any dividends that that company pays out. Okay, so individual stocks, they represent a share of a company or equity share, and they have a greater potential for return, but they also have a higher level of risk because, as we talked about last time, stock is a residual. It's a residual position, which just means that if a company goes out of business, the stockholders get nothing. The bondholders are in first position, stockholders are in last position or residual position, and they usually end up with nothing if a company goes bankrupt. Okay? Which is a real risk with a lot of oil and gas companies right now, that they'll go bankrupt because of where oil prices are right now. Bonds represent debt. Talked about that in the last class. So if you buy Microsoft bonds, what you're buying is their debt. Okay? And what does that mean? It just means that at some point they wanted money to grow their businesses, and so they borrowed it. They issued what's called a bond, which is a promise to pay back the money, right? To borrow the money and pay it back over time with interest. So if you go out and buy a bond, you're buying that promise from that company. And that bond is only as good as the company's promise. So if I buy a bond from a company that doesn't have any money and is not making any profit, I might not get anything back, right? But if I buy a bond from the US government or from Apple, there's a high likelihood that I'll get it back because both those entities have a high history of paying back. They also have a high or bright future as far as the ability to pay back in the future. And then we talked about in the last class the inverse relationship between bonds and interest rates. And this is an important conversation because a lot of people invest in bonds, even unknowingly, because they're investing in bonds through their mutual funds and their 401k, which is the most conservative thing that they can do. However, something to keep in mind is that interest rates we've talked about are at 30-year lows. Actually, in the history of keeping track of interest rates here in the United States, we're at all-time lows. But there's been a 30-year history, this latest 30 years, of a downward cycle in interest rates, which, if interest rates go the opposite of bond prices, that would bode well for bonds, right? It was a very good 30 years for bonds. What does that mean, though, for the future, for the next 30 years? Well, it probably means, maybe not for 30 years, but it probably means we're going to go through a period here where it's just not going to be as good for bonds because interest rates are going to probably climb back up over the next 20, 30 years. And when that happens, bond prices go down. So if I'm investing in bonds, I can expect my bond prices to probably go down over the next while anyway, 5, 10, 15, 30 years, depending on how long the cycle is. So just keep that in mind with your bond investing. Now, there are types of bonds that do better than others in a rising interest rate environment. Shorter term bonds tend to do better. Floating rate bonds or senior income notes tend to do better. High yield bonds tend to do better. Emerging market bonds tend to do better. So you have other options, but traditional bonds will go opposite of interest rates. And if interest rates are just bound to go up over the next few years, it's something that should create some pause with all of us before we invest in bonds or bond mutual funds. Okay? So just keep that in mind. All right, we've got preferred equities, which are kind of a hybrid security. They act like a bond, even though they're a stock. Basically, they're a special stock of a company that doesn't have voting rights like a common stock does. You can't vote on board members or mergers or acquisitions, but you do get paid a fixed dividend that's usually higher than the stock, and it's a preference. That's why they call them preferred securities, because they get paid out before the common stockholder does. So if there's only a certain amount of income, preferred stockholders will get paid and common stockholders will not get paid. Okay, so they're just kind of a different type of stock, but they actually act more like a bond. Then we've got mutual funds, and we've talked about mutual funds before, the reason that people do mutual funds. Okay, let's look at this here real quick. The reason people do mutual funds is because they're professionally managed, and you can balance your risk return really well because you're so highly diversified with a mutual fund. So I can put $100 into a mutual fund, and I might have a partial interest in like 300 different stocks. Okay, there's no way I could take $100 and buy 300 different stocks. It's just impossible. But I can have access to 300 different stocks and professional management through a mutual fund. It's called a pooled investment, and that's the reason people do it, is because they can lever their money into a highly diversified situation without having a ton of money. Okay. Exchange traded funds are very similar to mutual funds. You remember this from, I think, last class, right? I don't think it was this class that we had the exchange traded note, exchange traded fund versus mutual fund. It was that assignment where we talked about SPDRs. SPDRs are an example of an ETF, where Vanguard's an example of a mutual fund company, okay, that does regular mutual funds. And they are different, but they're very, very similar. Both are pooled investments. Exchange traded funds, though, trade throughout the day like a stock does, and mutual funds only trade once a day at the end of the day. Okay, and exchange traded notes are very similar to both of those. Okay, they're notes that a bank will create in order to track a certain category, and it's the good faith and credit of that bank that stands behind that note. You know, Michelle, I don't even remember now. I don't think that was week 1 in this class. Was it? Oh, it was week 1. Yeah. So, boy, I've lost it. I thought that was the last class, but yeah, you're right. That was week 1. And it was kind of a tough assignment because a lot of you have never heard of SPDRs before, never heard of ETFs, never heard of mutual funds. And so it was a good opportunity if you took it to research out the difference between exchange traded funds and mutual funds, and then also research out a little bit about Vanguard, which is a great mutual fund company, one of the premier mutual fund companies out there. No, you weren't losing it, Michelle. It was me that was losing it. Whenever in question, it's me, not you, right? Actually, we've proved that out quite a few times in this class, because usually I'm just talking through different slides and you guys can't even see them, and it's Michelle that keeps me on track. That's right. She does have to keep me on track. Different ways you can invest in real estate. Of course, you can go out and buy a rental property or a single family home and just purchase the property or finance it, right? But another way that you can invest in real estate that you don't have to own and manage a property is that you can buy what's called a real estate investment trust, or REIT, R-E-I-T. And REITs are somebody else managing the property for you, but still returning, your dividends from owning that property. So I can put $100 into a REIT. I can't buy a property with $100, right? So it levers my money. It allows me to get invested in real estate without having all the money that I need to buy a whole piece of property. And then I also benefit, like I say, from not having to manage it. Somebody else is managing it for me, of course, at a cost. And then they're returning, the rents from whatever property it is back to me in the form of dividends. Okay, so that's a way that you can do it. Another way that you can do it is that you can buy raw property that might be developed. You could develop property yourself. There's all kinds of ways to invest in real estate, both commercial and residential, all kinds of different avenues to do it. But a lot of people just say, well, I don't have enough money to invest in real estate, even for a down payment into real estate, so they might just throw some money into a real estate investment trust at a smaller amount. That way they have real estate investments, but they don't have to fork out all that money that it might require to actually buy a piece of property. Okay. You've got capital markets and money markets. Capital markets usually are instruments that are longer than a year. Money markets are usually shorter. That's why we call a money market account at the bank one that's a very short-term account, similar to a savings account. You got 2 different markets when it comes to capital markets with securities. Okay. When it comes to stocks, you've got primary markets and secondary markets. Secondary markets are the most common and popular. They're the ones that we hear about all the time. When we talk about the New York Stock Exchange or the NASDAQ, we're talking about a secondary market where we can trade stocks with other people. Okay, so if I want to buy Microsoft and I go to an online trading account to buy Microsoft, I'm not buying Microsoft from the company Microsoft. I'm buying it from somebody else who's selling it to me. Okay, so because the market's efficient because it's so large and efficient, there are always people trying to sell Microsoft, and there are always people trying to buy Microsoft. Now, you can still have companies that are what we call thinly traded stocks or thinly traded securities. If that's the case, you don't have very many people buying and selling, and so the price can be very volatile, and sometimes you can't sell when you want to sell. But most stocks that you can think of, all the stocks in the S&P 500, so the 500 largest companies in the United States, any one of those has thousands of people on a day-to-day basis buying and selling their shares. So if I want to go buy Apple or Microsoft or Google or Disney, or you think of a big company, I can easily buy or sell them without any problem at all, because there are always people willing to buy and sell. That's why it's such an efficient market. That's why the New York Stock Exchange is kind of the beacon to the rest of the world on how stock exchanges should work, because many countries don't have enough people buying and selling, and so they have very volatile markets. Even China's in that situation this year. They've had a very volatile market the last 6 months, in part because there aren't enough people buying and selling at any given point. So if there aren't very many buyers, it can really fall apart quickly. Okay? That's just how markets work. We want more buyers and sellers to make it more efficient. Okay? Primary market is where companies actually issue the stock for the first time. So an initial public offering, an IPO, is created when a company wants to go public. They go from being private to a public company. They do what's called an IPO, which a company called GoPro recently just did in the last year. You guys are all probably familiar with the video camera company GoPro, right? That you put on, your head, or you put it on the gear that you're using, or put it on whatever outdoor activity thing that you're participating in, and you get those really cool videos, right, of really cool things. As an aside, there's a GoPro video of a guy on a bicycle on this ledge on top of a mountain going really, really fast, as far as I'm concerned. Maybe it's sped up, I don't know. But it always makes me a little bit queasy every time I see it, because he's got like a cliff on one side and a cliff on the other, and he's just going down the middle of this peak. Anyway, point is, GoPro went public about a year ago. They went public because that's a way that they can raise a lot of money very quickly when you go public, because that's when stockholders are actually buying the stock from you, and they're paying your company to buy those shares, okay, of ownership. And then after the company goes public, then whenever you trade the stock, it's just between each other in the secondary market, like on the New York Stock Exchange, okay? So you have a private company like, Michelle, Tina, and Selena's. Let's say we open a bakery. We're selling, high-end cupcakes all around the country. We've got shops everywhere. We're making all kinds of money. And at first, it's just you and me as owners, right? It's just the four of us. We're all 25% owners. But then we decide, hey, this is getting too big. We want to grow this really fast. We want to take it all over the world. So we do what's called an IPO, or initial public offering. We offer our ownership, right, up to the public. That's what an initial public offering is. The public, investors in the public, buy from us our ownership. And we might retain some of our ownership. Let's say we retain like 51%. So we don't lose control, right, as a group, as our original team. But we sell 49% of the ownership, and let's say we raise $30 million, okay, from people buying our stock so that we can grow our company around the world. That's people who want to buy our stock because they believe in our company, right? A lot of people bought GoPro. A lot of people buy a lot of the technology IPOs that we've had over the past decade. Most famously, we've had companies like Google and Facebook and Netflix and Amazon, and all those companies over the past 10 or 15 years that have gone public. Those are huge companies. Millions and millions of dollars pour into them because people want to buy ownership. And that's exactly how people like Mark Zuckerberg with Facebook become billionaires. They go public with their companies, they sell out, okay, of a lot of their ownership, and then they make a bunch of money. Okay? So that's the primary market. Secondary market's what we see every day on the Dow going up and down, on the NASDAQ and the NYSE. Primary markets, when we hear about IPOs or initial public offerings, that's the primary market. Okay? All right. Yeah, not going to cover that slide. Got markets all over the world. We got regulators all over the world. We've got different regulations. This we did cover in the last class in 443, because 443 covers the Series 7 exam, and the Series 7 exam is very interested in making sure you know about regulation, right? We're not going to cover it in this class hardly at all. What is a bull market versus a bear market? We always hear those terms. What do they mean? Bull market just means that that securities are rising over long term. Bear market means that they're going down. Okay, so more commonly, people will just say, "Hey, we're in a bear market," and a lot of news reporters and people who do media just don't understand this concept. But a bear market is usually 20% or lower, or 20% or higher. So a bull market would be something where the market's gone up over 20%. A bear market would be the market's gone down over 20%. So most recently in January, people were freaking out about the market because the market went down over 10% just in the first month of the year, in January. Horrible month for investing. That was not a bear market though, okay? So some people report it as a bear market and they're just misreporting. That was what we call a correction. Correction is a 10% move downward. So once we move past 10%, that's in correction territory, what we call it correction territory. But up until 10%, it's not even a correction, it's not a bear market. When we get to 20%, we're no longer correction, we're in a bear market, okay? And bear markets, long-term bear markets, are usually an indication that our economy is in a recessionary environment, where we have negative GDP and a shrinking economy. That's usually, bear markets are usually a byproduct of a situation where the economy's shrinking. Okay. I'm not going to go over that slide. This is a really interesting slide, but it's probably too small for everybody to be able to see it. Okay, this is taking 110 years worth of history as far as the stock market and stacking them up in their average returns. You can see the most common thing for the market to do is to return between 10 and 20%. Okay. It actually is 1903. I don't know where you're looking, but yeah, it would say 1903. Somewhere on there. I can't even find 1903. But the purple ones are the last decade. Well, actually, I shouldn't say the last decade because this is an old slide, but it's from 2000 to 2010. So the most recent decade that it tracks are the purple numbers. So 2008 was that 30 to 40% negative. 2002 was 20 to 30% negative. 2001 was 10 to 20% negative. But then we get a lot of really good years. 04, 06, 09, 2010. Those are all 10 to 20% positive years. 2003, was a year where it was 20 to 30% positive. And then, decent years in 05 and 07, 0 to 10. Yes, you're right, Michelle. That's 1903 and 0 to negative 10%. You can see a lot of those 0 to negative 10% were in the 30s and 40s, though, too. A lot of bad years in the 30s and 40s when we went through the Great Depression, right? War years during World War II and things. 1 and 2. Anyway, very interesting slide. We don't have a lot of time to cover that, but I just did want to point it out. Do you see here, though, when I talk about investing for the long term puts the odds in your favor? What do I mean by that? This is exactly what I'm talking about when we look at a slide like this. Why? Because where are most of the boxes? Most of the boxes are saying in a normal year, you're going to get a return between 0 and somewhere between 0 and 30%. That is the most common thing that happens in the market. About 2/3 of the time, the market goes up and gives you good returns. And then about, close to somewhere around 20 to 30% of the time, the market gives you some kind of negative return. Okay, but that's very different than Vegas, right? Vegas, the odds are in their favor. The odds are against you. You're going to lose more than you're going to win statistically. The market, you're going to win a lot more than you're going to lose statistically. So it's very different. Okay? Can feel similar, but it's very, very different as far as the odds. Let's see here. SIPC real quick, and then we'll finish with that and we'll go on to the test. SIPC is insurance. So not to be confused with FDIC. FDIC is, of course, the federal insurance that's on deposits at a bank. SIPC is on investments for participating members. Okay, so if your investment company is not an SIPC participating member, you don't have this coverage. It's not just a coverage that's for everybody. Only companies that advertise that they're SIPC insured are SIPC insured. And as an investment advisor in the business for the last 14 years, every single firm that I've been with, and I'm at my 4th place, has me put out a disclosure that says that we have SIPC insurance. All the major firms have SIPC insurance. They want to show you that they have it because it's an important protection, right, for me or you as an investment person. It protects me up to $500,000 against fraud. Okay, doesn't protect me against fluctuation, doesn't protect me about bad investments. It protects me against fraud and a problem, with a brokerage company failing. Okay, so when Bernie Madoff went out of business, he actually was SIPC participating. His investors got up to $500,000 of coverage. The problem was many of his investors had millions and millions of dollars invested, so they lost everything but just 500. So if you were a local New York City charity and you had $30 million with Bernie Madoff, you lost everything except for $500,000. And yes, we'll take the $500,000, but that's devastating, obviously, to so many groups that had money with him. Okay, that's where I'm going to stop tonight for the slides in Chapter 11. Any questions, though, before we transition to the test? Anyone still awake? Michelle, you answered no when I answered if anyone's still awake. That was really good timing on my part, right? So I ask if anybody has questions. I don't wait for anybody's answer, and then I ask, is anybody still awake? And so everybody answers no to my first question. And I interpret that you're answering to my second question, which means that you're all asleep and just typing no, which is fun. Okay. You probably didn't even catch that. All right, so we got 25 questions on the test, all worth a couple points apiece, none of them very hard, pretty straightforward, all from Chapter 11. Should be a good week this week again for the assessments. And like I say, I've been very encouraged by how well you guys have been doing so far. So we start off the test with a couple true-false questions. The first question has to do with the definition of speculation versus investing. Those are actually the first 2 questions on the test. Both have to do with the definition of speculation versus investing. If you know the difference between those two, you'll get the first 2 right on the test. Okay? And we talked about it a little bit in the sense of investing versus gambling. But as far as the book is concerned and the test is concerned, it's investing versus speculating, right? So one of the first slides we looked at tonight. Number 3 on the test, we talked about mutual funds. And we need to understand the basics of mutual funds for number 3 on the test, and you'll get that one right. Number 4 on the test, just the definition of investment. Definition of investment. And what the book has to say about what investments are. Number 5 on the test. Number 5 on the test asks you, what are the prerequisites for investing? Okay, so in Chapter 11, it's going to talk about how to start investing. It's also going to talk about what you should do before you invest. Okay, and you'll want to know basically what the book has to say about what you should do before you invest. And you'll get number 5 right. Number 6 talks about different objectives for investing. We talked about how whether or not you're aggressive or conservative plays a major role in how you invest and what you invest in. So you just want to know those basic objectives and what that means for the types of investments you might invest in. We want to understand how common it is for somebody to invest only to shelter from taxes. I mentioned to you that there are products where we can put somebody in different products to try to shelter them from taxes, but that's not usually why people are investing. Usually people are investing to accomplish some goal in the future. And then a side or secondary objective is the tax piece, okay? Most people don't go out and say, hey, I want to invest because I want to save in taxes. They say, I want to invest because I want to grow my money or get income or do something, as far as get investment returns. And oh, by the way, I'd like it to be tax efficient and reduce my taxes as well, okay? So if you understand that concept, you'll get number 7 right on the test. Number 8 on the test is you want to know the difference between common stock, preferred stock, and bonds. What are those 3? What are their definitions? There were some slides tonight that we went over, but you'll want to review that in the test. Just have a basic working knowledge of what the difference between stock and bonds are, and you'll get number 8 right on the test. Number 9, you'll want to know about how often common stock paid dividends. How often do common stock normally pay dividends? You'll get number 9 right. Number 10 has to do with understanding the difference between common stock and preferred stock. Which one has voting rights? Which one has voting rights? You want to know that before you get to the test. Number 11, you want to understand what a prospectus is. What is a prospectus? I'll give you a heads up. It's a really boring document that a bunch of attorneys labor over and write. Okay, very long document. That's what a prospectus is. But you'll want to understand beyond what I just told you. What does the book have to say about what a prospectus is? What is the job of a prospectus? What is it meant to do? Then you have a question on the New York Stock Exchange, and each one of the exchanges has members of the exchange. Okay, and then they have people that are trading as part of the exchange that aren't necessarily members. Okay, floor members. So when you talk about the New York Stock Exchange, you have members of the New York Stock Exchange. It's kind of like having a country club where you have members of the country club, right? But I can still go golf at the country club even if I'm not a member. Well, most country clubs, right? Most golf courses I can go golf whether or not I'm a member or not. Just being a member gives me some extra benefits, right? Same is true for the New York Stock Exchange. There are members of the New York Stock Exchange. They have extra benefits, but there are other companies that also trade on the New York Stock Exchange. Number 13 has to do with regulation. You guys are all pros because of the last class, but what is the organization that basically is the head organization of regulation here in the United States? You want to know who they are and what they do, and you'll be in good shape. Number 14 on the test, just the definition between investing and speculation again. One of that very first slide, you'll get that one right. Number 14 on the test, if you know difference between investing and speculating, what those definitions were. Number 15 on the test, you're going to want to know, just have a working knowledge or working understanding of what those investment objectives were that the book talks about, okay? And out of a list of different objectives, be able to identify which one is probably not a valid investing objective, okay? So if you know which ones are, you'll be able to identify which one is not. Number 16, you'll want to know what the book has to say about the securities market. What is the securities market? What is involved in the securities market? Number 17 is about the different regulation acts. We didn't really cover it tonight because we had talked about the Securities and Exchange Act of 1934, 1933, Investment Company Act of 1940, all these different acts. You'll want to know basically what those different acts are and what they pertain to. Okay, just basically. You don't have to get into a lot of detail, but you'll want to just refresh yourself on what those different acts are. Number 18, just the difference between a bull market and bear market. We talked about that tonight. You should be in good shape on that one. Number 19, SEC rules regarding prospectuses. Just want to know about what the SEC rules about prospectuses are, or prospecti. Number 20, you're going to want to know about the book does a good job of just listing all the different securities exchanges, and it'll give you a list on the test, and it'll ask you to identify the one that's not an organized securities exchange. Okay, so if you know which ones are, then you'll be able to once again identify the one that's not. Number 20. Number 21, we didn't talk about this tonight, but there are different ways that you order when you're trading a stock. Market orders, limit orders. You want to know the difference between market and limit orders before you get to the test. It does test over it. Number 22 has to do with margin. What is margin? Why do we use margin? What is it when it comes to investing? We're not talking about margarine, the substitute for butter. We're talking about margin, which is a way that we can invest when we are trading stocks. But what does it mean? If you know before you get to the test, you'll get that one right. Number 23, just the definition of a portfolio. What is the definition of a portfolio? Get that one right. Number 24, just talking about objectives of a portfolio. Just basically, it's a really straightforward question, so I don't even need to go over it, but it's going to be really easy to answer number 24, but just be intuitive after you've read chapter 11. read through chapter 11 and you'll easily get number 24. Number 25, asking about what was involved with the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010, or what we usually just refer to as Dodd-Frank. Okay, we don't usually refer to it as its full name, but what is Dodd-Frank? What did it have to do with? If you know the basics of Dodd-Frank, not everything, because Dodd-Frank's huge, but basically, what does the book have to say about what Dodd-Frank was trying to accomplish? You'll get that last number 25 right on the test. Okay? All right. Hey, the test is pretty straightforward, pretty easy. You're going to be in great shape. Be confident, that you'll be fine when you get to the test if you read through chapter 11 and have your notes. Good luck this week. Give yourself a little bit extra time for the assignment now with the added components. Don't stress out about it, but just give yourself some extra time. Maybe get a start on it a little bit earlier. Don't wait until Saturday night at 11:55 to spend 5 minutes on the assignment. It's going to take longer than that. It's going to take a little bit of effort. It would be a lot easier if you'd actually read through chapter 11 before doing it. But chapter 11 is where the basis of all the material that you'll need for that assignment will be. Okay? Any questions, concerns before we wrap up for the night? Say good night and good luck. We're all good? Okay. Have a great week. Good luck. Let me know if you get stuck on anything. And check your scores. Okay. Check your grades. Everything's been graded that was turned in to this point. So make sure and check your scores. Check the feedback. Make sure you've got everything in the way it should be. Resubmit if you need to. Get the extra points you need. And let's go from there. Okay. Good night, everybody. Have a good one. Thanks for participating tonight. Thanks, Tina. Hey, all good, Michelle. That's a very good thing. I appreciate you. You're doing a great job. Have a good one.